What's up, everybody? Welcome to another episode. Today we're gonna start with two things that I really like: heavy metal and cash. There we go. What I want to talk with you today is basically three stocks that I do find very, very interesting. It has something to do with the development that we saw, especially over the last 1.5 years that took place in the stock market, and especially the trading activities. So I want to first give you a little background on what I think is important info, just to get an estimate what might happen in terms of trading activities and the stock market in the next couple of years. And then I want to show you the three stocks that are just super interesting, very low valued, and I think they might have some good years ahead of them. So I'm not an expert on macroeconomics, right? And there are countless factors that influence so many things in terms of asset valuation, trading, money supply, and so on. It's just so overwhelming, and I think that nobody actually can process all the information out there. So I want to just focus on the most basic things that I think are important just to know for understanding the certain mechanics that drive the market and that might influence those stocks that I want to talk about. So here we go. What happened since COVID hit the world in 2020? As we can see here in this chart that shows 12 of the world's biggest economies, the money supply just exploded, right? So there's a huge activity from the governments providing financial stimulus to the people, to the financial institutions, to the banks, and to the markets. And this money has to go somewhere, right? So where does this go? Well, you can put it in real businesses, you can put it in assets. And what happens when there's a lot of money chasing a limited amount of assets or businesses? Well, prices usually go up, especially in terms of assets. So this is important for me to know. There's a lot of money out there. I think they not going to reduce the money supply anywhere near. So this might keep at a record high, and money will be chasing opportunities. If we look here on this Bloomberg article, we saw that the downloads for brokerage accounts like Robinhood, E-Trade, Fidelity, and so on, the classics and the new ones, they just exploded. I mean, this is a chart that shows us the day-to-day downloads. But if we scroll down any further, we see what happened since January 2020. I mean, Robinhood just went through the roof. Also, the traditional brokers, they experienced rapid growth as well. And so what happened is actually money supply is being increased. People start to trade on their accounts, trading increases, and money is chasing opportunities faster. Some of these accounts are providing margin trading. And what we see here in this Financial Times article, US margin debt has exploded. So not only do we have real money going out there, not only do we have increasing brokerage accounts and increased trading activity, we also have a massively increased US margin debt level. So that means financial stimulus put out there to the people, to the institutions, gets leveraged up, and you have a multiple of that nominal amount being pushed into the markets. And what we can see on this chart is the correlation between the margin debt and the S&P 500 level. And as we can see here, these are basically just aligned. So if the margin debt goes up, the indexes go up. Well, simple mechanics, right? More money, more trading, more margin debt, leveraged up, chasing a limited amount of assets, so prices go up. This is important to understand why we are at a stock price or asset price level as high as we are right now. And it's important to know, is the environment going to stay like this? The biggest enemy of high asset prices are high interest rates. If we look at the interest rates in the US, those have declined massively, especially again in 2020, and the outlook is still not changing. I think this might stay a low interest environment over the next couple of years. I don't know how inflation is going to be, and I'm not an expert on that, and the factors to watch are just countless, and to figure out what happens, I mean, nobody can do it. If you could and you bet on it heavily, you can earn a lot of money, but if you look at the Forbes richest list, there's not one economist in there. Europe and Germany, interest rates super low, 10-year treasury bonds, negative interest rates. Italy, Spain, France, Netherlands, Germany, super, super low. I mean, where is this going, right? I think it's going to stay down there for a while. Okay, so far for basic economics. Before I'm going to name those stocks, I will recommend an article. It's on Seeking Alpha. Noah Riley, UK student, wrote an article that pretty much sums up everything that I want to tell you about those stocks. You get to know what the companies are dealing with, what services they provide, how they developed in the past, which setbacks that they had. And you can get a lot of information in this article. It's very well written. And basically, I agree with Noah on this article from a valuation point of view and from the point of view what lies ahead for those companies. Okay, now, first thing, what are those companies we're gonna watch dealing with? Actually, when there's a lot of trading going around, you not always want to be the trader yourself. It's like going to a casino. Sometimes when you're trading, especially when you're short-term trading, it's kind of betting, it's kind of casino environment. So what's the best thing to do? Right, owning the damn casino. In Germany or in Europe, it's not that easy to open a brokerage account in Robinhood and start trading options like crazy. If you want to trade options, you got to prove that you have deep knowledge, know about the risks and so on. And well, in Germany or in Europe, it's actually very hard to short a stock or to bet on a declining stock price. So what you can do, you can invest in something called a CFD, contracts for difference. The mechanics are basically the same like it is with options trading, right? You have an underlying that you bet on, you have a strike price, and the CFD or option expires at some point. But a difference between options and CFDs is the following. When you own a real option, you can get access to the underlying of that option, a share, a commodity, whatever. When you own CFDs, everything deals with cash. So you don't end up owning the underlying, or you don't have to sell an underlying. None of that happens. Everything gets evened up. There's a fictitious transaction taking place, like executing the option, getting the underlying, selling the underlying, and having the profit in your account. And with the CFD, there's this virtual transaction taking place that puts only money in your account. When you're right, you get the money. When you're wrong, you lose money. You don't end up having an underlying that you can just wait out or something. Those companies are actually service providers for these kinds of trades. CFD trading, spread betting, whatever, trading with those kind of derivatives. Here we go. Time to name those companies, right? The companies' names are Plus500, CMC Markets, IG Group. I do not really differentiate between these companies because I didn't really do a deep dive into their services that they provide. I did not really evaluate which one is better, which one is worse, because to me they are interchangeable. I don't actually want to go into the details because it's just too much effort for value added there. But on a first glance, it's obvious that those companies have just phenomenal fundamentals. If we look at Plus500, operating margin 60%, net margin 57%. That company has the best margins of all those three companies. CMC Markets 49-39 and IG Group 53-41. What's that telling me? That is telling me that those companies are profit and cash generating machines, right? Valuation, it's just, to me, it's a no-brainer. Price earnings ratio of IG Group, 10. Price earnings ratio, CMC Markets, 8.3. Price earnings ratio Plus500, 4. That's ridiculous. To me, this is like evaluating a fintech, right? Financial tech companies. If those fintechs are in an early stage, startup stage, whatever, super high valuations, if they make profits and still grow at rapid speed, they have much higher price to earnings ratios. There's a lot of positive expectations priced in. There's a lot of hope priced in. Maybe they don't even make that much profit, but they are valued just on a ridiculous price to sales ratio as well. This is 2.3 here, CMC Markets 3, and IG Group 4.2. I just think that this is a comparably low valuation if you value tech companies or fintech companies. Looking at the numbers, I always like to look at the revenue. Well, they had some setbacks. I think in 2016 and 2018, the government changed the regulations. They tightened the regulations, so they lost a bunch of clients. They had serious headwinds to deal with, but they adapted quickly, and so they got back on track. It's the same case for all those three companies. You see revenue declined a little, went up a little, declined a little, but here it's really starting to improve a lot because due to COVID, trading activity, money supply out there, everything that we just said before is a huge tailwind for those companies. And also the third one, IG Group, is just growing rapidly here from 2019 upwards. It's just crazy. And I think that they will continue to generate more revenue, generate more profit. We can also take a look at the cash flow statement. Cash flow down here, free cash flow, boom, 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 going up. Equity base, just going up. CMC Markets, cash flow. They were a little weak in the earlier years, but they have they did a great job in rebounding and generating free cash flow. Also, the equity base has just improved, and the same goes for Plus500. Plus500 is the only company that is not headquartered in the UK. They are headquartered in Israel, but they trade on the London Stock Exchange like the other two. What do we see about free cash flow? Yeah, increasing drastically. Equity base is also just very good and promising. I like fat margins. What can I say? The only risk that I see for these companies is actually just that the regulators step in. So if the authorities change the regulation on those derivatives, those can be major headwinds, right? But it's the same in every industry, I guess. Once the regulator steps in, every company will have the same headwinds. They will have to adapt. I do not think that the regulators step in and just put those companies out of business. They might have to adapt new financial instruments, new derivatives. Trading restrictions might be higher, but well, they adapted to those kind of challenges in the past, and I think that they will do it again. So for me, this is the only risk here, because once you enter a trade with those companies, they provide you the derivatives. They usually hedge their position. And what's their business model? Well, they earn money on the commissions for the trades, and those commissions are pretty huge. So there's a lot of turnover for a huge amount of money. And when you get a share of each transaction, and as we see on those margins, it's just ridiculous. For every dollar that you generate in revenue, you gotta own almost 60 cents. You gotta own almost 40 cents. And again, 40 cents. Why would you not like to be invested in a company like that? And as I said, there's no difference for me between the three of them. I mean, some of them have a more matured or sophisticated services that they offer, not only derivative trading, but also a traditional brokerage account for just keeping stocks, long-term investing, and so on. But you can trade there. And this is where they earn a bunch of money. So, and as long as the casino is open, the casino earns a bunch of money, right? And just to close the loop here, the information I gave you in the beginning, money supply, trading activity, margin debt, relationship between margin debt, money supply, and whatever is going on right now to asset prices, and the outlook from an interest rate perspective, that tells me that these companies might have a bright future ahead, at least in the near term and the next couple of years. I don't know if everything is already priced into the stock price. I don't really pay much attention to the value here. If trading activity keeps growing and their revenues keep growing, I mean, they just generate tons of cash. It's so incredible. And you want to be a part of that. At least I want to be a part of that. And that's why I invested in all three of them equally, the same amount. So I don't care if one is doing better in the short term or the other. I think eventually when the tide is going up, all of the stocks are going up. And I think they will continue to grow further. And when you look at the price earnings ratios, those are just ridiculously cheap. And if they improve and the market gets a taste for those kind of companies, and since they dominate this very niche, there's a huge moat for those kind of companies. So either the market is getting appetite for those kind of stocks and companies, the companies get appetite for each other, and we gonna be part of a bigger merger. And these might all be possibilities out there. Of course, government can step in, tighten regulations on trading. As I said, then we have headwinds, but just wait it out. I mean, if you own the stock, you own the stock and you can wait it out. If you own options on it, I wouldn't do options on it. That's just too risky for me. It's not my kind of style. I don't invest in options because they expire. There we go. That's all for today. I think those are three nice stocks to keep on your watch list. Take a closer look, do your own homework, do your own research. This was just a quick example just to give you an overview, fitting the whole framework for these kind of stocks, trying to figure out where does this fit in the picture of economic environment. But just because it works for me doesn't necessarily mean it will also work for you. If you're not into that stock, well, don't feel pressured into anything, right? Okay, so far, let me just know in the comments what you think about those stocks. Did I miss something? Did I miss something very important? I'm always happy to get constructive feedback. If you like the channel, subscribe. I already have like, 5 subscribers. This is incredible. Very happy about it. I'm not planning on growing the channel into the hundreds of thousands, but it's nice to actually, some people might take a little interest in what I have to tell. This channel is just for inspiration, education, sharing ideas, discussing ideas, and also exchanging feedback, right? So take care. I hope to see you soon and have a nice rest of the week.